Hello, everyone. My name is Hector Del Castillo, Chief Product Officer at Byond, and I want to welcome you to today's discussion. And today's discussion will be talking about 3 critical steps to boost your business valuation. And we're talking specifically to executives and founders that are working in companies that are doing either 3D printing or automation. And we are going to have some information about industry-specific information that we're going to be sharing with you. And this will be 3 steps that if you were to take them today, you will maximize not just the valuation of your company very quickly, but also the profitability of your entire business. So let's go ahead and get started. So for housekeeping items that I want to go over is that you are in listen-only mode, and you can submit questions either using the chat window or the Q&A window. Either one works. We'll be monitoring both. And also, if you encounter any audio issues, be sure to make sure that you refresh your browser, if that's what you use to actually join. And usually that addresses most of the issues. Also, we are recording today's discussion, so you'll be sharing a link where you'll be able to view the entire content of today's discussion. And our speaker for today is actually Laurie Wiggins, who's the CEO of Byond. Laurie, how are you doing this morning?
Doing well, Hector, and yourself?
Doing great, doing great. And looking forward to your discussion. So if you have any questions, audience, please feel free to type in at any time. We'll be sure to get to those during the content or throughout the actual discussion. And if we have some spare time at the end, we also will have a Q&A portion. So be sure to type in your questions as soon as you can so that we can get to them early on in our discussion. So without further ado, I'd like to introduce to you Laurie Wiggins. And Laurie Wiggins is the CEO of Byond. And she'll be talking to us today about today's topic. And I'd like to welcome Laurie. Laurie, welcome.
Hector, thank you so much. And welcome everyone to our discussion today. I want to give one shout out before we get started here. And that is to Scott Taylor, who does all of our video editing. So, who is this presentation for? So if you're a CEO and an intelligent, hardworking CEO, of course, and you're done building your business, it's time to go do something else. You're a CEO that wants to take care of their people, who wants to ensure that their IP is properly used by the buyer, or you're a CEO for lots of reasons who needs to sell fast. In this presentation, you're going to learn how to maximize your valuation and what you need to do today to make it happen. Does this sound like you? You have worked hard for years to build your business, and now you're ready to cash out so that you can take advantage of your next great business idea. You want to travel the world or whatever other plans you have. You need to sell in 2020 because of the pandemic, because of the pandemic layered on to other business or personal issues, but whatever it is, you need to start fresh somewhere else. But you're also deeply committed to preserving your legacy, and you want to make sure that your company is sold to the right people that are going to use your hard work in the right way. Today, there's nothing for sale. We are providing this presentation so that there is maximum value for you. If you can hang around to the end, we have a useful gift for you. Allow us to introduce ourselves. I have had the great luck to work with technical companies, technology companies for over 30 years. I have background as an engineer as well as significant business consulting experience. So I'm fortunate to have both areas under my belt. And I've been helping businesses grow their revenue since 2010. I really enjoy helping CEOs succeed, especially when they get a high sales price and they're able to walk away with the maximum amounts of money in their pocket. I'm a Virginia Tech grad, go Hokies, and I like to sing and travel with my family and friends. Also, our Chief Product Officer, Hector Del Castillo, has a long and illustrious career in technology as well. He loves to help CEOs buy and sell. He's a proud graduate of UC Santa Barbara and UT El Paso, and he's a running man. He loves soccer, walking, and running. A word about the manufacturing area. PMI is the Purchase Managers Index, and it is developed by surveying industry managers across all industries where there is manufacturing. High is better, obviously. You can see the 2020 dip that is due to COVID-19 here, and the point is that this index hasn't been this low since the recession in '09. So the pandemic has certainly affected manufacturing, and this is across all industries that include manufacturing. A word about manufacturing M&A. So it's in 2020, total deal value in the first half decreased by almost half compared to the first half of 2019. This is across all sub-factors, in other words, all industries that include manufacturing. Also, compared to first quarter of 2020, the second quarter of 2020 has seen deal value drop by almost 2/3 and deal volume drop by over 1/3. So in amidst all this bad news, how can we say that things are expected to recover in the second half of 2020? There's a couple of reasons for that. First, there's going to be continued divestment of non-core assets. There's going to be consolidations and, unfortunately, some bankruptcies. And this is going to drive an uptick in M&A by not only strategic buyers looking for companies that will enhance their offerings, but also via financial buyers who will opportunistically make investments. Also, there is an ongoing trend to de-risk the supply chain and make it more efficient. So we're seeing a renewed effort there, as well as bringing more manufacturing back to the United States. Easier said than done, but there's also a trend towards bringing your suppliers closer, localizing them more, which is going to drive some additional M&A opportunities. Also, there are ongoing uncertainties associated with the market for finished manufactured goods, as well as the continuing uncertainties associated with COVID-19. Earlier in the year, it was thought, hey, we're going to have the first wave. We'll get past that by summertime, and we'll be able to do some recovery before the second wave hits. That's now no longer true. We're in the first wave, and if we don't get a handle on things, we're going to go right into the second wave with no break. But all this is to say that this drives uncertainty associated with manufacturing company valuations. So this also will drive additional M&A. And lastly, there's the technology innovation factor. So we're seeing additional investments in additive manufacturing, in digitization and automation, including robotics. So this is going to help manufacturers be more efficient, but also de-risk or reduce the risk of operational disruptions. So for all these reasons, we do see a recovery in M&A in the second half of this year. Let's talk about how to maximize your valuation. The Valuation Maximizer Framework has three major areas. First is the sales objective. And this is, what are your goals for the sale? What are your metrics so that you know when you've achieved your goals? The second is overdependence. And this is in terms of key personnel as well as outside entities. And the third is unlocking your business wealth so that you can maximize your top and bottom lines. Let's look at each one of these in more detail in turn. So for the sales objectives, who's your buyer? What are their characteristics? What industry are they in? Is it yours or one adjacent to yours? Where are they located? Are they a competitor, a partner, a supplier? What is it about your company that helps you stand out from your competition? Are you looking for a strategic or financial buyer? Also, if you have more than one owner of your company, whether you have co-owners, you have partners, you have investors, they likely have a say as to when and how the business is sold. We were working with a company that had two owners, and they needed to sell the company. Owner A already had their foot out the door. They had established a nonprofit, and they were anxious to start working in that nonprofit full-time. Owner B was holding on for dear life. They did not want anything to change, but they knew the business had to be sold, and they wanted to stay with the business. It took these two owners over a year in order to agree about how and when to sell. And by the time they did, they had missed the opportunity to maximize the profits that they walked away with. So it's very important that you have this agreement across the owners. Also, what are the terms that you need? In other words, what's your minimum price? How much cash are you looking for at closing? Are you willing to take equity in the buyer's company or even help finance the deal? Are you, the CEO, going to be leaving at closing, or are you willing, or do you want to stay with the company after closing occurs? What about other terms of the deal, like earnouts, key employees and how to retain them, due diligence, closing conditions, expenses, shareholder approvals, exclusivity? These are the kinds of things that you need to be thinking about when you're looking at your sales objectives. Next, let's look at overdependence. First, overdependence on a customer. If more than 15% of your top line revenues, your gross revenues, are due to one customer, you are overdependent on that customer, and you need right away to increase your customer base and get that percentage down as much as possible. We were working with a company that saw 50% of their revenues based on one customer. And due to no fault of their own, but due to customer internal politics, they decided not to work with our client anymore. And it was devastating for their company. They had to lay off people. I mean, from one year to another, you could see that 50% drop in their revenue. You don't want to be there. Likewise, with a supplier, if you are over dependent on a supplier, increase your supplier base. Both of these are red flags to buyers. Finally, if you are over dependent on your CEO, if the company can't run or it can't run smoothly without the CEO, that's a big issue. You need to take steps immediately to empower the executive team, to improve your processes, to do what it takes so the company can run smoothly without the CEO. And even if you don't sell the company, this is just good business practice. Next, let's look at unlocking wealth in the business. And what I mean here is standing back from your business and looking at it as the buyer does, and looking at least the critical areas of your business in terms of strengths and weaknesses. Where are the gaps and how do they need to be filled? The idea here is to identify the underperforming areas of your business and fill those gaps so that all areas of your business can maximally contribute either directly or indirectly to your revenues and your profits. So we're talking about areas like your competition, your operations, your finances, marketing and sales, customer service, technology, your management, your reputation, your culture, and your cybersecurity. So these are the things that the buyer is going to look at during due diligence. And the costs incurred to fix any deficient areas come off their initial offer. Buyers sometimes go into deals assuming they're going to find problems and they won't really have to pay that initial offer. Prove them wrong. Do what is essentially due diligence before you sign anything with the buyer. And what you're really doing is not only helping to ensure that you get that initial price at closing, but you're de-risking the deal and increasing your chances of having a successful closing. Common gaps include things like marketing and sales, customer service, and cybersecurity. A word about cybersecurity. Sometimes CEOs of small and lower mid-market companies assume that because they are smaller, that they are less of a target for hackers. This is not correct. When a hacker either decides to intrude or is paid to do so, they're looking for things of value, and it doesn't matter what the size of the business is. If you have been hacked, and especially if you don't know it, that can definitely devalue your company and sometimes significantly. So this is a very key area, and if you haven't addressed it, you need to. When we do these kinds of analyses, we look for low-hanging fruit, and low-hanging fruit are those areas that are critical to the company that do have gaps, but they are either easy and or low cost to fix, especially compared to the additional value that they bring the company. So this is where you start when you identify changes that you need to make in order to maximize your valuation. Now that we've looked at each of these individually, let's look at the combinations. For example, if you have addressed your sales objectives and your overdependence, but you haven't done your gap analysis to unlock your business wealth, you're going to have a subpar valuation. If you've looked at overdependence, you've addressed that, and you've addressed your gap analysis, but you haven't taken on your sales objectives, you likely will not sell your company because you don't have agreement amongst everybody as to how and under what conditions that's going to occur. If you've unlocked your business wealth and you've taken care of your sales objections, but you haven't addressed overdependence, you may or may not be able to sell your company. If you have customer and or supplier overdependence, then you're going to have a subpar valuation. That is a big red flag to buyers. If you have a CEO overdependence, you likely will not sell your company because most buyers consider this a fatal flaw. So, how can you maximize your business valuation? The first way is the hard way. You can attempt to become an M&A expert. You can attend conferences, you can perform online research, you can go to expensive seminars, read books, join multiple masterminds, and hire expensive consultants. Or you can do it the easy way. You can follow this framework. You can do it yourself. You can be supported by experienced M&A consultants. More about that in a moment. Let's review. So what I promised you today was, number one, to show you how to maximize your valuation, and two, what you can do today to make it happen. Here's how we can help. What I am suggesting here, what I am offering here, is a 30-minute phone call. It's complimentary, to help you get clarity on three things. Number one, how much work it's going to take to get your business sold. Two, how to maximize the money you pocket after the deal closes. Three, assess your readiness to sell. So go to this URL and suggest a day and time where we can talk with you. And Hector, if you don't mind putting that up in the chat window, and that way it'll be up there for everybody to look at. Thank you. Further, we are planning a valuation maximizer workshop in the fall. So if you're interested in that, we'd like to hear from you. Email us at solutions@byond.com, byondma.com. And Hector, please put that up in the chat window too. So now, let's open it up for questions.
Thank you, Laurie. And I'm monitoring the chat window. I don't see any questions. Let me go to the Q&A right now. One of the questions that I had is, you mentioned that right now we're at an all-time low in the PMI in that index, right?
Yes.
But we're starting to see some recovery, because I think what I've read is that in June, July, it's been recovery, but we're not necessarily recovered quite back to where we were before the beginning of the year, right?
Mm-hmm.
What areas of manufacturing would you expect will be growing faster than others? Do you have any indications on that, or any niches that you're aware of that are growing faster than others in manufacturing?
Definitely. So healthcare and pharmaceuticals really did not see the kind of drop that other areas of manufacturing did. And that includes the manufacture of PPE, personal protective equipment. But with exceptions, everything else took a big hit. So I would expect that those areas, healthcare, health tech, and pharmaceuticals would continue to be very strong, and we'll see differential recovery across all other manufacturing subsectors.
Thank you. Thank you so much. I also want to point out that I think what I've seen also is that demand for disinfectants, in addition to things like Lysol spray and Clorox wipes or disinfecting wipes,
Yeah.
in addition to hand sanitizer. So Purell has been, those are the kind of areas that have been in growth. And actually it's attracted even new entrants, I think, in that scenario. So that, right now what you've seen is that no one, none of the leaders foresaw this happening, where globally now there's been a surge in demand for all of these products. And they were already, for the last 5 years, had already been consolidating and reducing and going into just-in-time type of manufacturing processes for those kinds of items.
Yes.
And getting them back up to, the ramp up in demand has literally been impossible for them. Just this morning, I read in the news that, disinfecting wipes, they're going to be scarce for at least a year, through 2021.
Wow.
And I think a part of that is that because of all the challenges, people were kind of going the opposite way. They were actually doing into cost reduction, and actually, expanding across regions and the way manufacturing and the sourcing of raw materials. And many of them were dependent on Chinese acquisition as well. In a way, they acquire raw materials. All of that has been really complex in their supply chain to kind of undo, because they were going in the opposite direction, so to speak, not knowing that there would be a sudden surge in demand, for some time. And I think that's been a challenge for some of these manufacturers. What about, what have you seen as far as like maybe in the 3D printing space, and anything that has been, experiencing growth, higher than expected growth?
The 3D printing area has seen growth year over year since the mid 2010s. I would say since at least 2015. And that's going to keep going into the 2020s. I mean, as the projections that I've seen, even to 2026, 2027, that's going to do nothing but grow. Right now, 3D printing is more applicable to low volume manufacturing, where you need certain things, but you don't need too many of them because it takes time for the layers to be built. It's very innovative, but it can be a slow process to build parts, especially if they're complex.
Mm-hmm.
But I foresee that that's going to continue to change, that manufacturing process is going to continue to speed up as technology gets better. And the faster that it can happen, that the more applications that you'll see it put to. They've even made 3D parts on the space station in a weightless environment. Very cool.
Sounds great. Sounds great. So you're expecting that still emerging and nascent right now, still requires some improvement, because it does take some time to create whatever it is, and it's not necessarily scalable, but there's still many of these printing manufacturers are actually trying to figure out how to reduce the time to get to something that they can scale.
I see that, and there's definitely deals being done within and between and on, if you will, 3D printing companies today, and that's increasing also.
Great. And I've been monitoring the chat window. I don't see any other questions, and I think we're on time. So maybe we can wrap up and then invite anyone else to submit questions offline. We can answer them offline.
Sure. Moving then to our last chart, if you would like to contact us, here's our contact information. Thank you for joining us today. We appreciate any feedback that you have on today's presentation, and stay in touch because we'll have more of these in the future. Again, stay well and stay sane.